Welcome back to Let's Talk Economics. Before we dive into today's episode, let's run through the latest headlines. Trump called it Liberation Day, but for Canada and global markets, it felt more like doomsday. On April 2nd, the US dropped a tariff bomb, a blanket 10% on all imports and 25% on foreign-made cars. China's looking at a 34% tariff hit, the EU at 20%, and South Korea at 25%. It's safe to say the world didn't take those tariffs lightly. The stock market went into full-blown meltdown. The S&P 500 took its biggest hit since the pandemic, losing over $5.8 trillion in market value. That's right, trillion. It marked the steepest four-day drop since the index was created back in the 1950s. The message from investors was loud and clear. Global trade wars are bad for business. Canada is also still in the crosshairs of this trade war, with 25% on steel, aluminum, and cars, plus 10% tariffs on non-CUSMA energy and potash. But Canada's not backing down and fired back with $30 billion in tariffs on U.S. goods. Prime Minister Carney isn't ruling out more retaliation, warning that U.S. exports like pharmaceuticals, lumber, and semiconductors could be next. Oh, and all of this is happening just 3 weeks before Canada's federal election, where tariffs are the ballot box issue. But let's shift gears and bring in today's special guest. Joining us is Brendon Bernard, senior economist at Indeed. He's here to break down what the latest market data is really telling us about workers, employers, businesses, and even the Bank of Canada. It's a deep dive into the mindset behind the numbers and what it all means for the economy right now. Full disclaimer, this conversation was recorded on March 26th, so some news may have changed since then, but the ideas remain just as relevant. So stay tuned and let's talk economics with Brendon Bernard. Hello, everybody. Thank you so much for tuning in. Welcome back to another episode of Let's Talk Economics. Today, we have senior economist Brendon Bernard from Indeed here, and we're going to be covering everything about the labor market, from what's going to be happening with the U.S. tariffs, what Gen Z is like in the workplace, and what trends he's seeing in Canada's labor market. Brendon, thanks so much for being here. Welcome.
Yeah, thanks for having me.
Awesome. So we're going to dive right in, and obviously the big question on everyone's mind is, how will the implementation of U.S. tariffs hit my wallet? And what does this mean for job security for Canadians? Could we see mass layoffs, wage stagnation, or will this fallout likely be more gradual? And on top of that, we're dealing with an affordability crisis. And just how much worse could this make the cost of living crisis?
Wow. So we're really starting out on a high note here. I'll guess, first of all, I'll put a timestamp on us. March 26th. And really that's important to kind of keep in mind because we actually have no real idea. And so all that is to say, we're still in sort of just forecast world, and forecasts are always abound with uncertainty. So in terms of how is it going to impact your wallet? Well, that's an interesting question to phrase it like that. Because with a trade war, the impacts are going to be sort of coming from all directions. And where you sit in the economy really is going to determine how you might expect things evolve. And so what I mean by that is thinking about U.S. tariffs on Canadian goods. That is an immediate shock to anyone involved in industries that sell stuff to the U.S. or provide services to companies that sell stuff to the U.S. So those sectors, they're pretty concentrated. They're manufacturing, natural resources, and wholesale trade. So the people who make stuff or get stuff out of the ground, or the people who package it up and warehouse it to be sold. And then, transportation and things like that, and lots of other businesses feed into those industries. And that's kind of on the exposed side to the U.S. tariffs. The economist Trevor Toom has done some great estimates about how many Canadians are potentially exposed to those shocks. It's about 2 million. In most provinces, it's like above 10% of workers, so one in 10. And so those are the first wave of vulnerability. Now, 1 in 10, or in Ontario and Alberta, it's like 13% of workers. That's exposed. That doesn't mean immediately affected, far from it. But workers in those areas all of a sudden have a new shock to their job security. And just like that, the future outlook for their businesses is just like totally up in the air. And so that's kind of like the front lines of this trade war. But then in terms of your wallet, it's quite possible that, especially in the immediate terms, the most notable impact comes from how we might respond to that. Right now, it looks like the tariffs are focused on consumer type goods rather than manufacturing inputs and things like that. But on the consumer type goods side at the grocery store, it'll show up pretty immediately. Now it'll be on a certain set of goods, whether it's produce or packaged consumer products, but that hits immediately. And the tough thing about dealing with these shocks is it's not like switching who you buy from. That doesn't solve the issue, because what it's going to do is it's going to shift demand over to either domestic or producers from other countries, which then tend to push up those prices of the unaffected goods. And so you can stop buying goods that are newly tariffed. Doesn't mean, though, that price won't be rising for other things as well. And so all those kind of channels are going to be at play. Just like how much depends on sort of where this trade world actually is headed. And really, like, we don't know so much at this point still.
Yeah, it's so fresh. And it's obviously, I in my last podcast episode, I kind of called it the hokey pokey, put the tariffs in, pull the tariffs out. There's just so much uncertainty of where things are going. Obviously, some more crazy news coming out of the US too, with security breaches, but a lot of big pieces. And it was interesting to your point about the grocery store. We know in Canada, there's a monopoly of where we buy our goods. A lot of mom and pop shops have been kind of put out of business from bigger name brands. I'm hoping that Canadian manufacturers are also bracing for that domestic demand to surge. But, there's also so many elements of how intertwined our trade lines are. So it's going to be interesting. And another point too, I'm seeing on LinkedIn and different social media platforms is as well as where you travel to kind of be part of that unification of Team Canada, of not traveling to the US, keeping your dollars and tourism within Canada. So it should be interesting how that kind of plays out. And you pointed out, we've heard the big numbers, as you mentioned, different provinces. Premier Ford specifically has also said Ontario could lose up to 500,000 jobs in the industries of manufacturing, steel, aluminum. But one thing that isn't being talked about, or at least I've heard, is who more specifically will be affected by this, whether it be the age group, men, women are most at risk of job losses. And I'm curious if, again, we don't know what's happening, but given the industries and the data, is there any indication of who these people might be and what this means for Canada's labor market and economic growth? And the reason why I phrased this question is because during the pandemic, we saw job losses and unemployment disproportionately affected women in caregiver roles. And, many people refer to this crisis as a C-session. And as we look ahead, do you think we could expect more specific groups being targeted?
I guess there are two sides to the shock, as I was kind of just going through, what the US has done and how we respond, and neither are good for the economy. And obviously, Canada is responding for kind of like bargaining a position, not because we think it's going to be good for the economy. But back to the jobs impacted, it's easier to kind of think of the jobs impacted more on the industries involved in export. And it kind of was talking about, the manufacturing and the resource sector, especially being the two large ones. Those industries lean male, manufacturing, resources, wholesale trade, a little more balanced, but, like disproportionately male. Manufacturing, a bit older than the average sector as well. And so definitely different profile of industries than what was impacted by the pandemic, and different types of workers as well, which has policy implications. It's not like a good thing, but like our safety net is in some ways better equipped to deal with this shock than the pandemic shock. Because back in the pandemic, at the start of it, you had shutdowns of the food service, accommodation industry, retail, things like that. though a lot of the workers impacted by that were not eligible for EI. They had not worked the sufficient number of hours in the previous year to receive EI. And so our safety net was just totally not going to be available for a large number of workers impacted by the shock. And so immediately we have to rush in with programs like CERB and things like that, which plugged the holes in the crisis. But you don't want to have to do that every time there's a downturn. In this case, though, in areas like manufacturing, wholesale trade, but lots of these areas that are exposed to U.S. trade, the workers there are full-time, permanent staff, not self-employed, not part-time, not temporary, which means a much larger share of the people whose job security is impacted will have access to EI, which was a real missing point in the safety net at the start of the pandemic. So in that sense, the pressure won't be quite as severe to sort of whip up brand new programs in response to the shock, though, I'm sure there are moves to be made. But yeah, definitely a different profile than the pandemic. I'll just add on kind of what happened in the pandemic. The group, especially during that kind of first 6 months, after 6 months, men and women evolved pretty similarly in terms of employment rates. And in fact, by 2020, not long after that, women actually started doing quite well. The harder hit from women in the pandemic was especially early on, and it was really among young women, under 25. And I think the main reason there is that they were working at much higher rates in the sectors that were just shut down completely during the start of the pandemic. And so that made the pandemic unique downturn from the gender perspective. I mean, the closure of schools causing not exactly job loss, but women to work fewer hours, even if they were still employed. And then just the fact that job losses were relatively even. A lot of time in recessions, it's those kind of goods producing industries like manufacturing and construction that are more cyclically sensitive and will fall first. And so men's employment tend to fluctuate a bit more. And this time during the pandemic, things were more even. And that was in itself something new hitting the economy too.
Wow, interesting points. And it's again, so crazy to think back that was all 5 years ago. And we're kind of holding our breath and bracing for another economic shock. To the point about women reduced hours, I volunteer with Moms at Work who actually advocated for changing the EI requirements because, to your point, a lot of people didn't qualify because they didn't have the hours, women transitioning from going into mat leave. So really so many different elements. And yeah, there's definitely differences with the US tariffs and that, but all really interesting points. And I didn't know that piece about women under 25 also being really impacted. And I think that's a great segue into my next point here about how we're talking about demographics and the type of people in the workforce is we're seeing a decline in young people landing their first jobs. And I want to point to a piece you wrote for Indeed back in December. And you pointed out that 25% of young people between 15 to 24 have never, emphasis never, worked before. And that's up quite a bit from 20 to 21%, where we saw in almost a 10-year span from your data here, 2013 to 2021. Why do you think this is happening? Is this trend driven by shifts in the job market as we're seeing the rise of AI? We're also seeing the Gen Zs and younger generation taking on a bit more entrepreneurial spirits. Or do you think there are other factors at play? As I mentioned, Gen Zs changing their attitudes towards work, traditional 9 to 5, or could it even be that hiring managers are hesitant to hire Gen Zs? There's a lot of data coming out saying and labeling them as the most challenging generation to work with.
I don't think it's either of those. So I think there's two kind of mega trends that have been happening, defining the Canadian labor market over the past 3 years. Since we left the pandemic, 2022, early 2023, the job market was really strong at that point. And any sort of characterization that you want to make about Gen Z and the workforce, for that to have a causal explanation for what's going on right now, it has to explain why youth employment rates, including among teenagers, were some of the highest we'd seen in quite a while in 2022 and 2023. So it's not like at the start of 2025, there's been a major culture shift in 2 years. At least I don't buy that. There have been changes in the economy macroeconomy that have just really turned around the youth job market from a strong one to a weak one in a pretty short amount of time. One is just like how the macro economy has evolved. Coming out of the pandemic, it was just a real job seekers market across the board. We saw job postings on Indeed soar in 2021 through the first half of 2022. By spring 2022, they were over 70% higher than where they were pre-pandemic. So job postings across the economy, basically every sector was looking to hire. Youth disproportionately benefit when employers are really looking to hire. And so that was a key factor supporting their employment rates. Since then, employers have pulled back a lot. They basically pulled back across almost every area of the economy except, let's say, like healthcare and maybe, some other public sector related industries. And so right away, not as good of a job market facing youth, just from a macro point of view. And this is kind of tied into interest rates. It's tied into the sort of normalization of the world after the pandemic sent it topsy-turvy. And so this is one part of the story. And this is actually something that affects everyone in the labor market. It's tougher to find a job regardless of your age compared to today versus 2022. Youth are more sensitive to that. But there's a whole other factor that has also been going on at the same time, which is Canada's rapid population growth. And the population growth really has been explosive among youth themselves. So Canadian population growth, driven by migration from abroad, starting in kind of like 2022, soared. And that initial increase was kind of like a bounce back after slow population growth years during the pandemic, the border closed and everything. But it soared way beyond that. And during this period when the economy has been weakening, the number of people in Canada under age 25 has just exploded, whereas the number of youth working has basically been flat. And so just way more competition within the group of youth for a dwindling number of job openings. And I think that these two ingredients have kind of come together at the same time to create a rough job market for youth. And interestingly, a lot of the sectors where you could think benefit from the surge in labor supply, they really haven't added a lot of workers. So for instance, if I bring together accommodation, food services, and retail, and some of these other administrative services, a lot of industries that have a lot of employment among temporary foreign workers, that we see the number of non-permanent residents in Canada soar. Employment in these industries is basically flat over this same period. So it's not like employers who are employing non-permanent residents are staffing up a ton. The headcounts are, I think, pretty similar, at least in aggregate. But the job seekers looking for those roles has surged, and it's created a difficult time, especially for people without much experience in the labor market trying to land that first job.
Absolutely. And really good points. And I want to dive into more of that immigration piece here and how that's impacting Canada's labor market stats and job growth and all these different pieces. In my recent conversation with Don Drummond, he pointed out that past immigration policies were rushed to fill low-skilled, low-paying jobs, which might have skewed the numbers and put a lot of pressure on both Canada's infrastructure and resources. But more specifically, I want to talk about a piece that you published on Indeed's Hiring Lab Economic Research, analyzing February's labor force survey. And in that, you noted employment growth slowed, layoffs remained low, and the employment rate stayed steady at 6.6%. But these numbers might not be telling a full story of what's really happening. And you and other economists have pointed out to February's slowdown in employment may be tied to that slower population growth, particularly following the federal government's new non-permanent residency policy. So my question here is, what trends are you seeing between lower immigration targets and Canada's overall labor market? And, from your perspective as a data expert, how has that shaped our understanding of the labor market? And has it, again, skewed any of this data, how we're approaching growth in the labor market?
Yeah. So Canada's population growth is definitely slowing right now. The population might be starting to decline slightly, just in the reversal of that migration boom. I mean, talking about interpreting the data, a key component of how the LFS is calculated is Stackhan's estimate of the size of the population. Because the way the LFS works is Stackhan surveys, 56,000 households across the economy, and it calculates the share of the population that is working and not. And then it comes to an estimate of the total number of people working by combining that employment rate from the LFS with an estimate of the size of the population. And the estimate of the size of the population, it tends to move slower than the actual population statistics. So throughout the second half of 2024, the population numbers in the LFS were growing faster than other data points on Canadian population. And so it's possible that Canadian employment growth has been growing a little slower recently than what the headline numbers suggest. But at the end of the day, the trends, the estimates will catch up. But, this whiplash in migration policy prior to tariffs was going to be, I think, the big Canadian labor market story in 2025. And I say migration policy, not immigration policy, because the two kind of systems have been different. By immigration, at least personally, I think of immigration as talking about the system for admitting permanent residents. I mean, we've got our three categories. We've got economic immigrants, family immigrants, and refugees. This is a system that's been in place for a long time. There's targets for each stream. Like on the economic side, until recently, it's sort of a clear point system for how people are awarded PR. That's what I think of the immigration system. Whereas when I say migration, like the surge in population has come among people with temporary visas to be in Canada, temporary foreign workers. There's the official TFW plan. There's the International Mobility Program, which is actually much larger, but the IMP program, and then the whole system for foreign students. This is what's driven the surge in population growth. Many people who'd like to be permanent residents, but their entry to Canada isn't through PR. We've had just a huge whiplash in that policy where all signals kind of like coming out of the pandemic were just expand, like we need as many people in as possible. And now seeing complete reversal of that, at least in policy direction. And in some ways, we're already seeing those impacts. We actually see it on Indeed. We track the share of clicks on Canadian job postings coming from job seekers located outside of Canada. And I've been tracking this measure for a while, and in my opinion, it doesn't, unbiased opinion, it does not get the pub it deserves, because it's actually been a leading indicator of some of these swings in population, where through kind of like pre-pandemic through mid-2021, about 6% of clicks on Canadian job postings came from job seekers abroad. And then starting around that mid-2021 point when international travel really loosened up, but also the government signaled that these programs were going to expand, we saw foreign job seeker interest soar. And by mid-2023, over 14% of clicks on Canadian postings were from abroad. So more than doubling in about a 2-year span.
That's wild.
Since then, though, it's basically fully reversed. And that reversal happened before the official population stats started to show a slowdown. And so on the inflow side of newcomers, I think we're already seeing these policies play out, but where the real source of uncertainty for the labor market in 2025 was there's so many people in Canada right now with expiring work visas who are not going to be able to get PR because the PR targets actually have been lowered a little bit, and we're never even large enough to match the huge number of non-permanent residents that had come to Canada. And so all that is to say there are lots of workers, students across the economy whose status going forward is going to be up in the air. Major challenge for them, uncertainty for them. And also it's going to be a shakeup for many employers as well. Some areas of the economy where I think like heavily reliant on foreign students and other temporary foreign workers, these are often are high turnover industries where the adjustment, it's not something that these employers aren't used to already. Maybe it's a higher degree of turnover than they've been dealing with, but it's not necessarily a shock totally out of the ordinary. But, there's going to be chaos when you have dramatic swings in policy in just such a short time.
I want to dive into that job postings piece. So job postings and full-time positions took a hit recently. TD reported a drop of nearly 20,000 full-time jobs, and your research also showed that total Canadian job postings dipped by about 3% in February. You also noted that the decrease in job postings isn't a dramatic shift, but where we get that notable kind of maybe gut-wrenching idea of what's going on, a 7.2% decline in job postings for manufacturing and production roles, which you described as, quote, a sign of concerning outlook for the sector, end quote. Can you dive into what's behind these numbers and how much of this slowdown is, as you mentioned, is it policy changes versus broader economic trends? Is it a sense of bracing for these tariffs? And what should job seekers and employers take away from that kind of data?
So I think my take big picture is, except for there's been a few news stories in the aluminum and steel sector, I don't think we've seen very much tariff impact at all, at least in terms of just the number of people working so far. But employers aren't just going to lay workers off at the first sign of economic uncertainty. But recruiting is inherently forward-looking. And this is where I think we're going to see some shifts show up when they do. In overall job postings, we saw, I think, a decline in 2.6% in February. We've seen declines like that throughout the past few years. So, like I was kind of describing earlier how job postings boomed, and now and that boom has fully reversed since. So there were a lot of months of 2.6% declines to get back from a 70% increase versus pre-pandemic back to zero. So that's nothing new, I'd say, for the labor market. But we saw manufacturing slow down a bit faster than the rest. And I think any outsized weakness we see in manufacturing job numbers these days, the most obvious candidate, it could be just random, which, hey, it's in the Canadian job numbers, that happens all the time. But my first thought whenever I see anything relatively weak in the manufacturing numbers is going to be like, okay, is this the uncertainty story? Like, are we seeing the first cracks? Maybe that's what we saw in February on employer hiring appetite. So far in March, they haven't been declining as quickly. So, I really think that kind of unknown of where actual trade policy is going to land has people just kind of cautiously just waiting and seeing. And maybe that's going to result in fewer new job openings in the near term, and especially investment plans. But I don't know if that's immediately showing up today, but that's where we are. And, once tariffs are in place, that's when I think the real adjustments are going to start.
Mm-hmm. Yeah, and I noticed that as well in your data. It seems to be whether the data is lagging or there's not that reaction yet to those drastic job numbers that maybe the media is kind of pushing and fear-mongering around. And I want to talk about job seekers, and job hopping is also, I would say, popular trend. Millennials maybe kind of ushered that in. Gen Z really took hold of that. And in past years, typically people would, if you job hopped, you could see anywhere from, I've seen data from 20 to 50% in an increase in salary versus someone who stays at a job position for over 7 years could only see a 2 or 3% increase. So loyalty, doesn't necessarily always pay the bills. But we are seeing a shift, and I want to point to your December piece for Indeed's 2025 Canada Jobs and Hiring Trends report, where you pointed out that job switching rates have steadily been declining, dropping to about 0.43% in November, well below pre-pandemic levels. So what's behind this shift, do you think? And are people holding on to jobs because of economic uncertainty? Or do you think maybe employers have finally realized that paying people fairly and a livable wage is maybe key to that retention?
Mm-hmm. Yeah, a lot of good questions to answer there. I kind of, though, want to rewind a little back to the start of the question on the characterization of millennials and Gen Z as job hoppers. Job hopping in the past 20 years, not just today, and this is born from U.S. studies, but I'm confident we've seen similar in Canada. Millennials and Gen Z change jobs less often than earlier generations. Job hopping used to be a much bigger deal in the 70s than today. Just the share of the workforce that had two or more jobs in a given year. And this is US data. It used to be in the range of like 13 to like 15% of people. And after the 2000s, it declined pretty steadily. And in the US data, by the mid 2010s, it was down. So I know there's kind of a sense that people, they get like a union manufacturing job and then work there for life. First of all, that wasn't everyone in the workforce. And also, what about all the jobs it took to get people there? Like the labor market has changed in a lot of ways that, yeah, people don't change jobs to the degree they used to. But I guess it doesn't necessarily show up in the vibes. That's kind of like just talking about the longer term trend, though. You know, what's going on more recently? So I will note, it's not just Canada that's seeing this. The U.S. also has seen job switching slow down substantially. There was a major pickup after the pandemic when the job market was really hot, and there were lots of people who probably would have wanted to change jobs during those shutdown years that didn't, and then took advantage of it when the market improved after the crisis. And so there's going to be a reversion to the mean after that. But yeah, both Canada and the US, people are not changing jobs very often. Canada, it's especially low. It's been especially low in the past few years. And, you know, what's happening? I think part of the story is just employers, like the cool down in employer demand. There is a definite cyclicality, job hopping. When the market cools down, people aren't as confident. The allure of job openings aren't as great because those job openings aren't necessarily as high quality. I think like one factor going on here is we have seen in Canada a shift in where people are working and the types of jobs people are working. It's kind of like coming out of the pandemic where self-employment is down and the public sector is up. And that might be indicative of a sort of broader trend that people have found in a lot of ways the quality of and stability of jobs has improved, that people are working in more stable employers where they're comfortable staying at places longer. And so this could be one of the factors driving the change. But, you know, I think there's other things going on, which I don't have a great story for, because why does the U.S. also look similar? It's not just Canada as one data point. When we see two trends happening in different economies at the same time, there's got to be some common thread there. I'm not exactly sure what that is, but we have seen in Canada this shift, right? Like public sector employment, whether it's in government, but also like healthcare and education, have been among the strongest areas of growth over the past few years. Also, white collar areas like professional services, banking and finance, these have also added a lot of jobs over the past turnover sectors. Whether it explains it all, I doubt it. And there's, I think, some other things missing in the story that I can't put my finger on.
And as we're kind of wrapping up here, interest rates set by the Bank of Canada play a huge role in the economy. And you mentioned that in one of your earlier responses about the impact of interest rates. But not everyone can connect them directly to job growth and all these other different pieces with labor market and businesses. Can you break it down for us? How do you think interest rates do impact hiring, wages, layoffs, and maybe even overall job creation? And we know that the Bank of Canada has had consecutive rate cuts, which has been great, also very uncommon. We also have another one coming up on April 16th, but I'm just curious if you can help explain to listeners if there is a correlation or connection between job growth, creation, and interest rates.
Yeah, it's tough. I want to clarify, but the world isn't so simple. And one reason is that interest rates affect the economy, but the economy also affects interest rates. So the Bank of Canada is cutting because they think that the economy is relatively weak and that interest rates need to be lower so that inflation remains at its 2% target. So the causation runs one way from interest rates to the economy, but also from the economy to interest rates. And so falling interest rates can decline because the economy is getting weaker and because all those things like investment and hiring are getting weaker. And so all that is to say why interest rates are falling doesn't necessarily spell something good about the economy or bad. You got to kind of think about what's driving the underlying shock. That said, typically when the economy goes down, the central banks are looking to cut interest rates aggressively to get ahead of that weaker trend, in part because interest rates financing costs in general are one of the important inputs in the decision to invest, to borrow, and to spend. Lots of construction projects think about the hurdle rate for investment. What degree of profitability does this investment need to justify allocating capital? And if interest rates are higher, it means that it needs to be a very profitable project to make it work. And so this is one of the aspects of how interest rates can feed into the economy. But in this kind of context, hiring in some way is kind of an investment as well. It's a sort of a plan for your future workforce. And of course, it's different than capital. The supply of labor is different than the supply of capital. And there are lots of nuances there. But in other ways, businesses are making adjustments in their plans based on whether a certain level of investment and employment is going to be what is best for their business, maximize profitability. And if interest rates are higher, then maybe it makes sense to have a scaled back business. Don't not expand your workforce in that higher rate environment. And just so happens the timing of those rate hikes, both in Canada and the US, and I think around the world, they coincided pretty closely when job vacancies started to decline in kind of like mid-2022. The first rate hikes started earlier in 2022, and then by kind of Q2, that's when things had peaked and employers started pulling back. And so I wouldn't be surprised if those two trends were directly related. And so that's one side of the equation on interest rates. But interest rates are impacting the economy through lots of different channels. We're very familiar with the housing channel and consumer spending and that side of things. But in the labor market, that sort of a consumer demand, housing demand, that also impacts businesses and how they're are evolving. But my main kind of thing that I think about is thinking about hiring decisions and recruiting decisions in the context of overall business planning, which involves both investment in capital and plans for the workforce going forward. And where interest rates in the sense are kind of like the price of money today, and if they're higher, that impacts decisions on how large businesses want to ultimately be. And I think that's one of the key ways that sort of interest rates and their changes flow through to the labor market. And interest rates, it's pretty rare that they don't decline during recessions. So maybe lower interest rates weaken the economy. Well, that's not the way causation works, right? Like you've got to disentangle all these underlying shocks, and then you have these policymakers responding to those shocks. At the same time, you see lower interest rates, you can't just jump for joy because often they're lower because the economy's gotten weaker.
All really interesting points. And Brendon, I want to thank you so much for being on Let's Talk Economics. We covered so much and expertise, and all this amazing data is so critical, and really looking forward to other work you're producing. But all that being said, any other closing thoughts to our conversation, or maybe where you think the future is going towards Canada's economy and job market?
Yeah, so the Canadian economy is in such a state of uncertainty right now that we didn't even have any time to talk about AI, which, I do think is a really big deal. And over the next 5-10 years, I do see it having some pretty transformative impacts. How that exactly works out, it's more speculative, but this is a major trend that's looming in the background. And rather than diving into it, I think the fact that an hour could fly by talking about the labor market right now just gives you a sense of what a wild time it is right now to be following the Canadian economy, where we have the first major technological wave, and I don't want to say revolution, but major technological breakthrough that we've seen in a while since I think the computer it came on the scene is looming, and that we didn't even get to it, but maybe I'll come back and talk about that sometime.
I was just about to say, I'm taking that as an invitation that you're going to come back. We're going to dive into the AI world. And I can assure you my stocks are also very happy with the AI wave and my semiconductor funds on my portfolio. But Brendon Bernard from Indeed, thank you so much for being here. Let's Talk Economics. We'll definitely have you back to talk about AI. And thanks so much for everybody listening. Tune in next week for our next special guest as we dive into Canada's economy and politics and policy. And the fun never stops here. Thanks so much.